Hello, everybody. Welcome back. This week was pretty good for me. We had a nice little spike in the VIX on Tuesday and Wednesday, which was a great selling opportunity. I come out with my account being up about 1,100 on the week, but I had a lot of plays that only lasted like 2 days, and I'm going to call that my money tree segment. This video, like always, I'm going to go over all the trades I did, talk about why I put those trades on. But first, I want to talk about the VIX and how I use that to kind of gauge how much of my capital should be in play at any given time. So, as always, here's the daily snapshots of close for my account. I don't pay too much attention to them. It's just kind of a gauge of, am I too exposed to certain options or not? So first off, what is the VIX and why use it? Well, from Wikipedia, VIX is a ticker symbol and a popular name called the Volatility Index. Is a measure of the stock market's expectation of volatility based on the S&P 500 index options. It's calculated in real time and is sometimes referred to as the fear index. All right, so basically what this is it's a tool that you can use to measure the market sentiment, whether it's the market is being bullish or bearish, and if there's going to be implied volatility coming up. Basically, market makers use this to help price options overall to hedge risk and stuff like that. If there's a lot of questions about how the stock market's going to move in general, people will buy calls thinking they can get rich fast, or they'll buy puts in order to hedge and protect against a giant drop in the market. And to offset that, the market makers will tend to increase the prices of options, enticing more people to sell options, which is what I typically do, is sell options. And an even shorter version is like the more fear and volatility there is, the more premium that goes into the options. The more premium in options means we can play a little safer, we get wider strikes, and we can get bigger returns because obviously we're getting paid more to put on these positions. We're getting paid for the risk we're taking on, and it just happens to be at a premium. In our Discord, some people have been bringing up how they deploy their capital based on the VIX. So depending on what level the VIX is at, is how much of the allocation of their buying power they're going to be deploying. And this is basically because scaling back in low IV environments reduces exposure to margin expansions. So the VIX drops to 15 and you're sitting at 50%, and then all of a sudden the VIX goes up to 24. Well, every option play that you're short has just had premium injected into it, and your margin's going to expand, and it's just not pretty. To reduce risk for margin expansion, as VIX is lower, deploy less capital. Now, I was doing some research. I keep seeing like a table similar to this pop up. I think this might have originally been made by Tastyworks, but I'm not entirely sure about that. Basically, if the VIX is between 10 and 15, you should deploy about 25%. If it's between 15 and 20, deploy 30%, and so forth. The higher the VIX is, the more money you should have out there because you have a better chance of IV crush, making you get profits quicker, is essentially what this is all about. And if it's low, there's more risk to you of margins expanding, which will go against you pretty quickly. So you want to have less money out there so that you don't, suffer greatly if that does happen. There's also other volatility indexes. So you got a 9-day one, you have a 3-month, a 6-month, and a 1-year. And I was actually looking at these today when I was researching what I was going to put in this video. And it was pretty interesting when you look at like a side-by-side comparison of the VIX, the 30, the 30-day, the 90-day, and the 1-year. How typically the VIX is lower than the other three, but on days where the VIX is higher than those, premium goes up pretty high, and typically the next day or two, like that gets sucked right back out, and the VIX goes back under the levels of the longer period times. It makes sense when you see like a period like this. In the short term, there's less risk because there's less time for stuff to happen, which is why you expect the 1 year to be higher. So it's interesting when like it doesn't follow that pattern and the VIX is higher. Looking at the 2-year chart, you can really see where that played out during the pandemic. So like the March 23rd area here, you can see the VIX skyrocketed. So did the 90-day, the 6-month, and even the 1-year. But if you see what this actually means, like the 1-year, so people in the short term are saying, wow, we don't know what's going on. In the short term, we are scared Okay, but the 1 year volatility index didn't raise as much because it's saying, a year from now this is all gonna blow past and we'll be fine. So this was a prime time to be selling some premium because it'll just get crushed typically as this line goes back under uh, the other averages. When I was looking through my trade log, I was seeing on days where I happened to sell contracts when this period was happening, when this scenario was happening. Those were the options that typically closed out in a couple of days because the IV crush just happens. So I'm wondering if going forward, I'm going to try to pay more attention to this. I need to do some more back testing. But on days where the VIX is higher than the, let's say, year and 6 month volatility index, like those might be perfect days to sell and maybe be a little bit more aggressive selling premium than on other days where the VIX might be lower than the said comparisons. So just something to think about. If any of you guys actually use the VIX like this or look at the other volatility indexes, let me know how you guys use those in your strategies because I'd be very curious to see how others are using that. With that said, we're going to get back into the weekly review portion. And this week, I did see the account go up to 198,700, which would have been all-time highs. Except the last 2 days has been a little sell-off. I'm in a pretty bullish position. So I ended the week only up $1,100. Realized premium for July is up to 6,500. What I really like to see is like the year-to-date total is up 73K if you compare those two numbers. So that's pretty awesome. I love options. So as you can see, this week I did a lot of trades. But first, I'm going to talk about the money trade, or the money tree. So I kind of view this as I planted some seeds early on, poured some miracle growth on, called IV Crush, sponsored by VIX, and when those sprouted, took those off immediately. So in this 1 week, a lot of trades that were longer DTEs just got closed down because saw instant profits because VIX dropped, volatility dropped, so premium got sucked out. So a nice little $634 of contracts that I just put on for the day because premium was paying a higher price. And when VIX lowered, I was able to take them off for a profit and not have to wait the 30 to 37 days that I was selling most of these for. So amongst those were Fastly and Palantir. Both of those guys, great entry points, I thought, for those strike prices. And if we look down here, here's Fastly. Closed it out pretty quickly. Closed it for 80, so that's like 20% in a day. Because actually, I think this is the same day, so 20% in the first day that it was on. So that was pretty nice. The Palantir, I closed it for 29, sold it for 45. So another quick win, $150 for holding it for 1 day. Zoom, I put on a 300 put, and if you can see, the next day I was able to close it for a nice $114 gain. JP Morgan, Cloud Ninja pointed this one out to me. Put it on Monday, and then if you look the following day, was able to close it for a $60 gain. What else did I put on here? Suns is probably the only one that went bad for me this week, and that's because it was a covered call that I sold, and I ultimately decided that I'd rather just close the call and get out of the shares, so that was the weed in my money tree experience. Lost $105 on that guy. I sold a Netflix iron condor, or maybe it's called an unbalanced iron condor. Basically, I started by selling the 450-445 bull put spread. I sold 5 of those contracts, and then I sold 2 call contracts because these were 10 wide. So the max risk for the call side was 2,000. The max loss for the put side was 2,500 because I did 5 and 2. And those guys I closed out the next day for about $158. The max profit would have been $385 if I held it to the expiration date. But I figured why hold it for 30 days when I already have, 40% profit off of that trade. So close that one down as well. Thursday, this is Wednesday. Wednesday, I did sell a 470 put. This is after earnings and the moves were already priced in. And by Friday, Netflix started going back up, and so closed it down. So a 2-day hold for $180. So pretty nice money tree picking right there I had. Now looking at the other stuff, I sold some puts on CCL. It was sitting around 21, I want to say, on Monday. So 17 puts seem pretty good to me. If I had to take assignment, I will. So again, easy play to make. I picked up some Wish at 9:35. For most of the week, this seemed like a good trade as Wish was up, but I think it finished on Friday down. So right now that's down. I closed my Campbell Soup puts again because I had profit and it was in the money, so might as well just close it and take a profit since I could. I closed some T puts and then sold a strike lower further out in time for a small credit. Picking up pennies, but if it's AT&T, I don't think it's gonna get to 26, so that's free money, I think. I closed down my Clorox poor man covered call. My short strike got breached, but my leaps were up, so decided just to close it down rather than roll the cover call, because who knows if Clorox was gonna retract or not. Figured I have a profitable trade now. Let's just take it, lock it in. Picked up 100 shares of Nusi because apparently I'm the biggest dividend investor ever. What I do here? Here I closed some calls on AT&T. AT&T was sitting around 27.50 or so, or near it. So these calls I thought I could take off and follow AT&T up, let my leaps be uncapped while AT&T came back up. So I closed these for a profit, and my T leaps I have are sitting there uncapped for the moment being. I did sell some more Campbell Soup 44.50 puts about a month out. And again, I think we'll be fine on those. Even if it's in the money, I'll probably come out with a profit. And I got paid a commission for that, so that's always nice. I closed my Coke leap down. I put this in one of my videos that I was going to open up this and, what was it, VTS or VRTS. And Coke was up 20% for my leap, so 2-week hold, 20%. I'll take it. Suns, that's supposed to be a quick swing trade. And so since Suns went up and I was able to close it out for a profit, I took that. That's like $364 on 3,230. Pretty nice return right there. Was at 10%. I sold the rest of my AT&T shares because who wants to hold AT&T right now? No, let's be real. It's just 5 shares, so I just want to get that out of my portfolio and stop looking at it. And then I also closed down my ITP Colony. I just decided that the strategy is not for me. Like, I make money playing on larger cap stocks that seems safer to me, so that's why I closed down that experiment. I know I said I could lose 5,000, be fine with it, but why lose 5,000 if I already learned what I needed to learn from that? So close it down, especially since it was an up week. Seemed like an easy call to do. Realized total for the week was $19.93, and then I also should get a dividend of about $101 from my shares of Nusi. Here's my current positions. Is looking pretty bare right now. Got a bunch of leaps that are down. VST's back up, so that's nice. This Baba put here at one point was up 50%, and I was thinking about closing it, but since it's a rolled position, I didn't. And it's just the one trade I think I probably should have done in hindsight. Obviously, everyone's correct hindsight. What else? Anything else in here worth talking about? SoFi 14.50. I think SoFi's at 15, so that's just premium, just waiting to cook. Palantir's, Virgin Galactic. That got closed. I think the rest of this pretty much speaks for itself. MindMed, I'm still just holding that. That's a play where, like, if MindMed gets up to like 350, I'll sell it for a small gain. It's supposed to be a short-term swing trade. I don't expect to hold that for more than a couple of weeks if needed. And then Wish, obviously I brought my cost basis down by buying more, but I still have 1,000 shares in Wish. Something that I thought was interesting was looking at the Nusi position. So Interactive Brokers gives you 4-to-1 buying power. So I have 557 shares, so I get $101 in dividend. The market value of this is almost $16,000. And the amount of buying power, or the margin I'm using to secure this, is only 4,000, because 4-to-1. And so it's just something that's kind of neat to think about. Like, I'm making $101 technically on $4,000 here because it's just margin, and I get that 4-to-1 buying power. So I'm only using $4,000 to secure this position that's paying out that amount, which changes like the monthly payout percentage significantly. I thought it was neat. So anyway, I think that wraps up this video. There won't be a video on Sunday because I have some family matters to attend to. But I hope you all had a good week. Let me know how you did. If you're using VIX in your trading plan, leave a comment. Let me know how you're doing it. I would love to hear how you're using it. Maybe set up a discussion or something like that. And thank you for watching.